Okay, welcome everyone once again. So tonight I would like to talk to you about financial instruments and unpack that topic a little bit. I'm first going to deal with a bit of theory, and then in our session that we will have on Sunday, we will deal with a bit more exam questions. We're also going to do quite a bit of questions tonight, and obviously I would like you to participate and ask questions. And guys, please, if you see something that you don't agree with, you are more than welcome to ask. I will not take offense. I can make mistakes as well. So this is a interactive session where it's not just me presenting. It is a participatory class. I would like to know what you think, what you've done, and questions you might have. You might actually be helping someone else as well. Okay, so just a reminder then also of Sunday's session. If I'm not mistaken, I think the time is 11 o'clock. However, the correspondence will be on the WhatsApp group. So for those of you that did not yet join the WhatsApp group, please send, if you want to, it's a voluntary group, so please send your module code with your name to that number, and I will gladly add you to the WhatsApp group. On that group, I share the notes that we will be doing tonight. I make notes on a tablet, or I do some questions, and then after the session, I share it on that group. So if you haven't joined it yet, you are more than welcome. One-on-one consultations, there is a link in the chat section that deals with the one-on-one consultations. If you don't know how that works, or if you can't find the link, you're also welcome to send me a WhatsApp and I will send the link to you. So how that basically works, if you would like a one-on-one consultation with me, then you go onto UNISA's platform, the link will take you there, and you will log a request, and then I will attend to that request at the soonest availability. I will go to that list. It's a nice list that tracks all the requests, and I can respond there, and then I will contact you and I'll ask you when will be a convenient time for you and me to meet, and then we will discuss whatever problem it is that you have. Please be specific with your query. So if you have a question, just be specific. It will assist me as well to prepare for that consultation session. Then attendance register, as I've already asked, please post your student number in the chat section. We do not have an attendance register link anymore. That chat section is our way of keeping attendance. Then there will be a session evaluation form at the end of the session where you can please evaluate the session and if you found it helpful. Okay, so before we start, let's quickly talk about financial instruments. Let me just put up the right screen. I'm just going to make a few notes. One moment. Okay, so yes, guys, overall, financial instruments can be a very daunting subject or topic because of it being spread over more than three IFRS standards, and each one of those standards deal with a specific aspect. So not all of it might be in the sphere that you are dealing with, but you must be able to identify what each of them does. So if we look at financial instruments, you must realize that we are talking about assets. On the one hand, we are talking about liabilities on the other hand. And we are talking about equity. Very important in your preparation for the exam is you need to be able to distinguish what is a financial asset, what is a financial liability, and what is an equity instrument. Because as you know, with accounting, as we've gone through all the other IAS standards, there's various sections in the standards that deal with recognition. What should we recognize it? Then obviously we need to measure it. Once we've recognized it as one of those three items, we need to measure it. So once we've measured it, we need to know that there will be initial measurement and there will be subsequent measurement. Very important. Guys, I've just lost my page here. You guys can still see the screen because it shows it's not sharing.
Yes,
thanks, guys. Just quickly going to fix it on my side. I'm not sure why it shows that it's not sharing. Okay, there it's back. Okay, anyway, okay, so I was at initial measurement. So that's on day one when we acquire this financial instrument, and then obviously subsequent to day one, how do we value it annually? How do we take it through the various financial statements? Does it go through profit and loss? Is it a reserve? Because you guys know, for instance, ISA 16, property, plant and equipment, if we revalue machinery and equipment and those assets, we create an equity item called revaluation reserve. So it's important that we understand how we measure it. What items are included in the cost? What can we capitalize as part of that if we're dealing with an asset, for instance? We need to understand that. Then, obviously, something that you might not always deal with, but we might de-recognize an asset or liability or financial instrument. What are the conditions? And then something I really want to focus your attention on in your preparation for this, especially for financial instruments, is presentation. Presentation, the disclosure in the annual financial statements. Guys, please, for this subject, it is extremely important that you understand how to disclose the various topics that you deal with. A lot of marks go for disclosure because you have two components to a question. Mainly, a question can ask you to do the calculations. It can ask you to do journals. And then obviously the third component, I said two, but there's three, is disclosure. And please remember for the exam, and you guys will always hear me say exam technique, even if you did your calculation wrong, in the question, the required section would read, complete the statement of changes in equity or complete the asset section of the statement of financial position. That is the required. That is the part that you will be examined on, and that's the part that will be marked. Yes, there will be a lot of marks going to calculations, but you're not going to get zero. You are going to get some marks, even if you did it incorrectly. You are going to get some marks for your effort, because something might be right there. Not everything will be wrong, but then you will get full marks if you transfer whatever you've calculated there to the correct places in the journal and the disclosure. You debit and credit the correct journal and you put it in the right disclosure. So those two different types of understanding that you need to have of accounting. It's not just calculations. So calculations is one thing, but don't lose out on the other marks that are sometimes so easy to get. And those are the marks that will make you pass even if you had a bad paper. So please always take note of exam technique. Nothing is just calculations. So having said that, I'm going to pause now at each of these points with financial instruments: recognition, measurement, when we de-recognize, and presentation. Let's quickly go to recognition, initial recognition. So let's talk about initial recognition. What are the important things that you need to remember there? So recognition generally refers to when an item would be accounted for in the financial records. Therefore, the initial recognition specifically refers to timing. Remember exam technique, what I always say? You go to the required first, point 1. Then you pay attention to dates, because you need to know what they want for when they want it. Extremely important dates. You need to understand when you need to account for, or when you need to do this required part, or when you need to account for a specific transaction, a movement in the in the transaction, and to take that to the correct annual financial statement. It's important. You need to pay attention to dates. You highlight every date that you read in your exam. You highlight. So when we deal with financial assets or financial liability in the statement of financial position, you can, when you deal with financial instruments, you can only recognize it when you become a party to the contractual provisions. So timing leads to when that happens. So there must be a contract. Read the question very carefully. There must be a contract in place. I'm quickly going to put up an example for you. Let's read through this. Guys, please ask questions. This is a discussion group. I would like it if you guys can participate. So company A signed a contract on the 1st of January. There's a contract to order a quantity of raw material. The raw materials were delivered and risks and rewards transferred on the 31st of March 2013. If the order contract is not accounted for as a derivative financial instrument, the transaction will be recognized on the 31st of March 2013, when risks and rewards transfer. If the order contract is accounted for as a derivative financial instrument, the transaction will be recognized on the 1st of January. So they will let's read the second part. If the order contract is not accounted for as a derivative financial instrument, the transaction will be recognized at 31 March 2013. So to get back to my notes that I made here, you must be quite sure when risks and rewards transfer. The date is very important because the date will tell you when you should recognize. Any questions so far?
Yes, I have a question, Charles.
Who's asking me? If it's yes,
It's Sylvia, sorry.
I saw. No problem.
Okay, so I wanted to find out in the with this initial recognition, would they
Yes.
have to say that it is a signed contract agreement, or can it also include a verbal contract?
Good question. Since common law recognizes verbal and written contracts, I would say a verbal contract will suffice. I can't see any reason why that, from a legal point of view, that will be a problem, as long as it can be substantiated that risks and rewards can transfer. So there must be no doubt that risks and rewards will transfer from one party to another. Did you have a specific example where that happened?
No, I was just thinking about, what if.
Okay, yes. No, well, good question.
Thank you.
Okay. Okay, so let's talk about initial measurement. So that's where we determine what the value will be of that item. So there we specifically deals with IFRS 13. Okay, where they speak of fair value first. So fair value is basically the most common measurement at initial date when that happens, and that includes discounted cash flows. The quoted price. Any questions on that? But what does quoted price means? What does this means? We must also have a look at an active market. Remember, it's always important to when they tell you give you the fair value information, and they say a active market, because that means fair value can be reasonably determined, and that's the key word in financial standards, is reasonability. It can be reasonably determined. If there's no active market, how are you assigning a value to that asset? So if there is no active market, then you have to look at recently quoted instruments. And it must be similar instruments. Everybody happy so far?
Yes, thank you.
Okay. Okay, so that is where we speak of the initial measurement at fair value when we look at IFRS 13. So, so basic things to remember there: fair value is generally the quoted price, but it's not uncommon to use a valuation technique. So always be open to that, and if they give you the information. If we look at an asset, we will generally more focus on IFRS 9, where they talk about the gross carrying amount. amount of the financial asset. What does that mean? If you think about leases, the lessor will have an investment in the lease. And that will be calculated using gross carrying amount of that financial asset. And that also is the amortized cost. Don't laugh at any spelling mistakes I make, please. Amortized cost. Okay, and so yeah, so that's if you look at a financial asset, always be ready to make sure that where payment extends beyond normal credit terms, time value of money needs to be taken into account. So the moment that they say we're gonna you don't have to pay for the next 6 months or wherever, and the question then states, but this extends beyond normal credit terms, then you know time value of money needs to be taken into account. Everybody happy?
Yes.
What rate do we use if we discount, if we do discounting? What interest rate would we use?
Shouldn't it be disclosed in the question?
Yeah, it would, or you should have to calculate it, but it's the effective interest rate. So you guys that have that's got your financial calculators ready, quickly assist me with this example. So the example that I want you to calculate, they say we issue a bond. Okay. With a nominal value of 1 million rand. Okay. It has a coupon, and this is an important one. It has a coupon interest rate of 10%. Annually in arrears. Okay. This was done on the 1st, let's say Jan 2013. They say the bond will be redeemed at its nominal value. So redeemed at nominal value December 2015. What will the effective interest rate be? Can you guys calculate the effective interest rate for me? Whoever calculates it first, you can say what do you think it is. Remember, we issue the bond, so the present value today is also $1 million. The payment is 100,000 because it's at 10% of that value. The future value will be $1 million because they say we settle it at future value, and N will be 3. So you should get an I that equals the coupon rate. But what happens if they say, add now to the above example transaction costs of 15,000, and you say the coupon or the bond will be settled at a 5% premium. In other words, 5% more. What will I be then? Okay, I'm going to leave you guys with that for about 2 minutes.
Hi, Charles.
Hi.
It's Lungile.
Hi, Longile.
Yeah. Is it not 5%?
5% is the premium at which it will be settled.
Which means that's payment.
Yes. So the payment will be the 1 million plus the 5%
Okay. Thank you.
of 1 million. Okay, guys, let's have a look. What will my present value be? Remember, it is less transaction cost. The future value will be the million times 1.05. The payment will be still the coupon rate of 100,000, and the period will stay 3. Now you say compute I. So the interest rate is 12.11%.
Sorry, Charles.
Yes.
Just to ask with the future value. Since the premium is at 5%, why are we now saying times 1.05? Is it not times 5%?
If you say times, because the premium is 5%, in other words, it is 5% above the million. So we just add the 1 in front to say it is the million times 0.05 and adding it to the million.
Okay. Okay, thank you.
100%. Any questions? No questions, guys? Okay, let's move on. So let's quickly look at a financial liability. We haven't really touched on a financial liability. So a financial liability, you have to classify what was the use of it. What did we use it for? And remember, financial liability, as with a financial asset, we also use the amortized cost. So everything is always at fair value. So that you must always remember at initial recognition. So if we, for instance, have a liability, and the main reason that we incurred that liability is for getting rid of it and repurchasing it in the near term, in the near future, so usually within 12 months, then it's not a normal liability. It's a liability held for trading. Okay. So you must always make very sure when you read a financial instrument question, what is the intent? That is the key word. What is intent? Why was it purchased? Why was it incurred? If your purpose with any of these financial instruments is really to make short-term profit, then changes in it will be dealt with in the same way as we would have dealt with inventory. If you think about inventory, what is the main rule for inventory in terms of subsequent evaluation or valuation? We value inventory at the lower of cost or net realizable value. So the moment that we have a financial instrument that we have for short-term profit making, we also need to take that same approach where that adjustment in the value goes through the statement of comprehensive income. Okay, so if we have a financial asset or liability, we will hold it at fair value, amortized cost, as we've explained now, but any movement, subsequent movement, will go through profit and loss. Okay. The initial measurement, and here's the big difference. If it goes through profit and loss, it will always be excluding transaction cost. In other words, we will take it out. It will be less. If it is held as an investment, so if for investment purposes, so if it's for investment purpose, then we say it is not held for trading. and any adjustments will go through other comprehensive income. In other words, we will recognize equity. And in that case, we will say it is the fair value plus transaction costs. As opposed to the example that we just did. Any questions? Guys, you must feel free to ask questions. The exam is on its way.
Could you please show us an example with regards to this liability?
With
this financial liability, can we do like an example so that we could see?
100%. Let me quickly find one for us.
Excuse me, Charles.
Nokwanda, yes.
Yes. I just want to find out, does it matter if it's for a limited company or for a PTY limited, taking it to other comprehensive income?
No. No, it wouldn't really matter because it's still the treatment of the underlying asset, the underlying transaction.
Thank you.
Doesn't really, the IFRS is not really written to distinguish between a limited company or a PTY limited. I'm just getting an example quickly for us. If you guys also know about a example in your question bank, you are welcome to share it. I think I found one. Very good example is debentures, for instance. Remember, debentures is a liability. Okay. Let me put up an example. You guys see the screen roll?
Yes.
Yes.
Okay. So it says there, on the 1st of January 2013, Invest Limited purchases two 12% 5,000 Rand debentures from SB Limited, a company listed on the JSE Limited, at their fair value. The debentures mature at 108% of nominal value in two equal annual installments payable on 30 December 2014 and December 2015. Interest is payable on 31 December The market-related interest rate in similar debentures with the same terms as these debentures is 15% per annum. Invest Limited uses settlement date accounting to account for all financial assets at amortized cost and has a 31 December year end. Assume the transaction costs of R100 in total were paid by Invest Limited in respect of the purchases of the debentures. The objective of Invest Limited's business model is to hold the debentures in order to collect contractual cash flows. The contractual terms of the debentures gives rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. SB Limited did not designate, for classification purposes, the debentures as measured at fair value through profit and loss. Assume that credit losses on the debentures were not expected at any stage. So now we say amortized cost. What will the future cash flows be if we have a look at this example? Let me put up my Excel and let's do it in there. Because I'm just quickly going to unshare. So they say we purchased 12% 5,000 Rand debentures. And let's pay attention to the dates. They say there on the 1st of January. On the 1st of Jan 2013, we incurred the fair value plus transaction costs. Do we know what the fair value is yet? We only know what similar debentures can reach. We don't know what this value is. Agreed? So that is what we must calculate. We want to calculate the present value of future cash flows plus transaction costs. Everybody happy? Okay, let's look at the information again. They say here, interest is payable on 31 December. What is the interest? 2 times 5,000 times 12%. So 31 December 2013, we incurred interest, and the interest was 1,200 Rand, which is the 5,000 times 2 times 12%. Same for 2014. So 2014, and 2013, because we got it on the 1st of Jan 2013. So the full 2013 year and the full 2014 year. And the 2015 year. But they say interest is payable on 31 December. And here they say the debentures mature at 108% of the nominal value in 2 equal annual installments. So we already know what that cash flow will be. So at the end of 2014, after we've calculated that interest, we will also repay a portion, or there will be a repayment of a portion of 108% of the original value. So that will be 10,000 divided by 2 times 1.08. Happy? Then we move to 2015 and we incur interest for the full year, but now on half of the amount. Because we've made a there was a repayment. And then we have a similar occurrence. There's a repayment of 5,400, and that is our future cash flows. So now we need to calculate what the present value will be. And here you need to be able to calculate use your calculator. Okay, now I leave you guys to calculate that NPV for me. Say 2 minutes, not even. First one with the answer, please. Give it to me, please. Guys, any answers yet? Sylvia?
I'm still trying to calculate this.
Okay, 100%. Should I give another minute or two?
Yes, please.
100%.
Is it 964285?
That's very close. Let me quickly calculate. What is the rate firstly? What rate did you use? Hi?
12%.
Why 12%?
Hold on, sorry, I'm just looking at the question.
Remember they say the market-related interest rate on similar debentures.
15, sorry.
15%. So 0.15. I just want to delete some of the periods because my calculator there will include the various lines. So for the 2013 year, it was 1,200. For the 2014 year, it was that plus that. For the 2015 year, it will be that plus that. So equals NPV. We use 15%. There we go. So the journal for that, to journalize that, will be investment, because we issue the debenture, so it's investment in debentures. And bank, because we pay for it, we purchase it. What will that amount be?
Isn't it the 9979.12?
Yes, that'll be the first journal. Remember, if we issue the debentures, it's our investment, but we give away money to people. People that subscribe to the debentures. And then also, investment in debentures.
That's the transaction cost.
Future value, cash flows, plus the transaction cost. Let's look at another example. I just don't want to do another debenture question. Okay, let's do this. This looks like a nice question. So, Invest Limited had the following transactions in the ordinary shares of Spec Limited during the year ended 31 December 2013. On the 1st of January, the balance was 8,000 ordinary shares at 95 cents each. On 10 February, we purchased another 4,000 ordinary shares at R1.10 each. And on the 31st of March, Spec Limited had a capitalization issue of 2 ordinary shares for every 5 ordinary shares held on 25 March 2013. 15 May, we sell 3,000 ordinary shares at the fair value of 70 cents each. And 30 June, on this date, the market value per share was 75 cents. The 1st of July, Spec Limited had a rights value of 1 right for every 10 ordinary shares held. In terms of the rights issue, the holder has the right to acquire 2 shares at 50 cents per share for each right. The rights expire on 50 January 2014. And then Invest purchased 500 rights at 43 cents each. On the 5th of October, we sell 600 rights at fair value of 45 each and exercise 400 rights on the 8th of November. The 15th of December, we sell 6,600 ordinary shares at the fair value of 68 cents each. What is immediately evident from this question? What's the intent? Nokwanda? If we have to decide, Nokwanda, between did we purchase these shares to invest, or did we purchase them to trade with?
I would assume that we purchased to trade with.
Yes, I agree, because of all those transactions, it looks speculative in nature. So those are also the words that you need to be on the lookout for in a question. It's words like speculative, held for trading, because the moment if it's held for trading, the standard says it is we value them at fair value through profit and loss. In other words, all movements in the value of these shares will go through profit and loss. Everybody happy? Any questions? Guys, don't you have any questions? Okay, I quickly want to open last semester's question paper, and I just want to see what the question in there was and put that up on the screen for you guys. Okay, question 4. Desky Limited acquired 5,000 shares in Super Limited on the 1st of January 2018 at fair value of R3 per share. Transaction costs amounted to 1,500 and the company elected to recognize subsequent changes in the fair value of its investment in other comprehensive income. It is furthermore the company's policy to realize any gains or losses resulting from the fair value adjustments to retained earnings when the shares are sold. So here they say additional information. On 31st of December 2018, the market value of Super Limited shares was R3.15. The next year, we sold 2,000 shares. And on the 31st of December 2019, the market value of Super Limited shares was R2.85. I'm going to give you 4 minutes just to do for me the first initial recognition journal. For 25 marks, guys. So the initial journal entry. Please let me know if when you're done. Guys, anyone ready with that journal? So the first thing that you need to recognize here is that it's Jasmine.
Hi, sorry. Okay, so I'm done. So we would recognize it on 1 Jan 2018. We'll debit the financial asset at fair value through other comprehensive income and credit bank. So the amount will be, it's the 5,000 times 3, which is 15,000, and then we'll capitalize the transaction costs.
Brilliant. So let's quickly do that. So you will debit the investment in shares and you will credit bank. This value will be the 5,000 times the R3, So it's 15,000 plus 1,500. You guys happy with that?
Yes.
Guys, I'm not going to stretch this session out any further, but what I will do is I will post this question on the group. Any other adjustments? We'll go to an account that we call the market-to-market reserve. So we will debit for any increase, we will debit the investment because it's an asset, and assets increase on the debit side, and we will credit the market-to-market reserve. Everybody happy with that? 100%. I will post a question on the group now. If you guys are not part of the group yet, please send your name and name and module code to the WhatsApp group, WhatsApp number, and I will add you to the group. Are there any other questions? Anything else that you guys would like to ask before we conclude the session?
Sorry, Charles, Sylvia again.
Hi, Sylvia.
With regards to the previous semester's exam question,
Yes.
the 2019 portion, how did you say we had to handle that? I completely missed the answer there.
No problem. Every time that there's a valuation that you do, you write that valuation to an OCI account, other comprehensive income account, and we call that account the market-to-market reserve.
Okay.
Does that answer your question?
Yes, thank you so much.
So an increase will then be we debit the asset and we credit the market-to-market reserve.
Perfect. Thank you so much.
100%. Any other questions, guys? I've shared it on the group. If there's no other questions, guys, please remember to post your student number in the chat section, and please complete the evaluation form. I would really appreciate it. I'm going to stay on for another 3 minutes if you guys have got questions. Just unmute your mic and ask. I'm here. Guys, there's no class, there's no group sessions on Saturday. The class is on Sunday from 1 o'clock. And the main topic for that class is we're going to be doing previous exam questions, focusing specifically on the bigger statement of financial position question, or your bigger statement of profit or loss and other comprehensive income. So it's quite an important session. We're going to be doing an exam question.
Please can I have the WhatsApp number to be able to join the group?
No problem. I'll quickly post it again in the chat section.
Thank you.
I've posted it.